We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. Mike, thanks for joining me today.
Thanks, Tom. Thanks for having me back on. And I miss, since we spoke last time, I'm looking forward to next time. Looks like we're going to solve some world problems in this conversation, I hope.
Well, that is my greatest wish, is that we can solve some of the world's problems here. Mike, I think an interesting place to start is to look forward. You know, you recently posted 3 keys for commodities for 2025. Yeah. So why don't we start by thinking about the bad for commodities? What is the bad looking for the year ahead here?
Well, the bad is good for consumers. So remember that the bad for prices going down is more the same. Let's look at, start with the world's most significant crude oil. The number one word that comes to mind when I speak of crude oil is glut. We see declining demand and imports from China. Even Sinopec recently put out that China's gasoline demand's probably peaked. Proliferation of EVs. And we see increasing supply and excess supply surpluses from the U.S., Canada, most of North America, even South America, and increasing OPEC spare capacity necessary to keep prices just stabilized. So that price should continue to go lower, which is great for consumers and bad for producers. So to me, there's good ways and bad ways to look at it. I look at this as superabundance is a wonderful thing, particularly if you're in North America. Massive excesses of food and energy in the U.S. and Canada. U.S. and Canada combined, the supply surplus of crude oil and liquid fuels is running 6 million barrels a day. To put that in context, in 2008, when crude oil peaked at 147, it was a deficit of 10 million barrels a day. So, you know, it's just a wonderful thing. And what's the main country in the world that really needs all that energy? It's China, where they're obviously getting from other sources. So to me, overall, the trend is downward. I see that definitely in the grains. Superabundance and glut's a word that comes to mind. And every time right now you look at the grains, the first thing you have to do is check out what's happening in Brazil. Their currency is plunging, their weather is awesome, and their supply is just kicking in. I mean, the massive superabundance of corn is mostly soybeans and corn. So that's good for consumers, bad for prices, and even everything pushing lower. But the number one, now we can tilt over to gold a little bit. Gold's the one I expect to still go higher. But the number one metal I think that really matters for it next year, that has to go up, that I'm fearful that will go down, are the industrial metals, i.e., they have to show that the world's recovering where it's not. They have to show that maybe China's recovering where it's not. And the number one commodity there is copper. And I think copper, I'll end with this. Copper right now, as we record on December 19th, is $4.07 a pound. I think it's more likely to go 3 than to 5.
Mm-hmm. So I guess inherent in that, in the copper equation and in the crude equation as well, is this idea of global demand. So is that what you're really seeing, is this slowing of global demand being manifest in those two prices?
Well, you nailed it right there. This is, and from commodities, we see pretty significant global deflationary forces. Let's start with the number one indicator for that. I think it's that Chinese 10-year yield at 1.76. Compare that to the U.S. at 4.59. I mean, that's almost a 300 basis point spread. That's pretty severe deflationary forces in China as bond yields. I've always been a government bond yield person. And then you've also looked at, let's say, bond yields of the top 5 countries by GDP in the world. We start with China, Japan, Germany, UK, and India. The average of those 5 yield is over 100 basis points below the US, showing that deflationary forces. To put that in context, in 2007, before the great financial crisis, the average of all those countries was about 100 basis points above the U.S. So gold outperforming virtually all commodities, particularly the S&P 500. As we speak right now, gold's up about 26% on the year. The total return for the S&P 500 is 25%. But you're not really hearing that so much in the public, on CNBC and in the broadcast media. You're hearing how great AI-driven stock market is, but when the rock beats stocks, that's not a good sign for the global economy. And I'm fearful that this process of the stock gold beating the stock market will accelerate next year, particularly if digital gold has a bit more of a backup.
Well, Mike, before we get to that comparison, what does China and their spending right now? They've announced that they're going to be deficit spending next year. How is that different than what the U.S. does? Year after year running these big deficits.
Essentially planned economy. I just heard from Michael Pettis, I think he was former Goldman Sachs, I forget what university's head of, pointed out that, and I've heard a lot of other analysts say that total debt to GDP in China is about 300%, because everything's centralized. China's no longer in China, and respect its history, its past, and its future. Just one person, and he's solidified. He's solidifying his autocratic rule, and they have become a major oversupplier of renewable and potentially renewable sources, and potentially export of deflation, partly because they have to, because of malinvestment and no market forces in a closed market. And the key thing is they've been running deficit spending, particularly in 2007-8 crisis. They pumped up their massive deficit spending, but the difference is it's all centralized. It's all under one person and leader. It's not an open market, and it's doomed to fail. And it's happening right now. So let's put it this way. It's in the process of mean reverting. Rapidly advancing emerging markets almost always have severe mean reversion periods. That's what's happening in China. Not that complicated. The difference is I've been using the comparison for years to Japan and the Soviet Union about 3 decades ago. The difference is President Xi's tilt towards the former major Cold War adversary of the U.S. in North America, Russia, towards Putin, and being a decisive enabler of a war in his best customer's backyard, and that's according to NATO, that's not my quote, is epic and historic. And it's like, if you want to GMTFO, get me the heck out of a country, that was a good signal for it. So this is accelerating. There will be pretty significant tariffs. These are things that have been worked and been hashed out by Mr. Trump for decades, that things like people like me have been waiting for decades. And, that whole idea that, let's have free trade now. He's like, yeah, everybody wants free trade in the world as long as they can run a surplus with the U.S. is changing. Fine, we're going to see a test. But that's going to be discombobulating. It's going to see volatility. It's probably going to see a little bit of short-term, maybe correction in equities, earnings hits, and things like that. But the bottom line is the geopolitical situation is a Cold War getting hotter every day. Now, the good news is Russia's starting to get bogged down. As we saw what happened in Syria, they're starting to show the cracks in the armor. Chinks in the armor. But I think the bottom line is people need to see what happened here is President Xi, by making this unlimited friendship, has it's created the axis of four antagonists. It's China, Russia, North Korea, and Iran. And two of those countries, North Korea and Iran, want nuclear weapons, and Russia has them. Boom. And who has troops in there fighting a war from now? I mean, it's just shocking. But so the market's still priced for significant detente, and we're getting a Cold War getting hotter every day. Now, of course, Trump's going to solve that one day, and that's part of the problem. The optimism in this country for the new president to keep this stock market going up and keep risk assets going up is pretty extreme, and it's way overdue for a reversion. But overall, geopolitically, macro, you can see now we've had some issues in Canada with leadership. Certainly in Brazil, the currency is down 20%. Germany tilting on recession. Obviously, China's completely dependent. Here's what I like is commodity traders know that every day that goes by, they're just waiting more and more stimulus from China so they can see bounces in things like copper and industrial metals, and maybe crude oil, so they can sell. It's completely priced in. We need that. They have to have more stimulus. It'd be a shocker if they don't stimulate more. So we've seen that tilt towards even France is having issues, and it's all partly because of what I think. It's not because the global economy is doing great. So to me, the bottom line for 2025 is there's an inordinate burden on the U.S. stock market to keep going up. It was up about 30% this year, and I think the risks are it just has a little reversion. And Bitcoin may be the best leading indicator of that, because this new president, who was, I call him the Trump transmogrification, who tilted from antagonist of cryptos towards a complete zealot, has now staked the claim of his government on the cryptos going up, yet there's massive froth and speculative excesses there. So I painted a picture of a normal reversion in the U.S. and the global economy after the biggest money pump and the distortions of the pandemic and the invasion of Ukraine. But I think it's a tremendous environment for those more tactically orientated, in a great trading environment. But it's way overdue. I mean, I'm talking about normal reversion, just a little backup in the stock market, say 20%. That hasn't happened in for how long? And it's just so expensive. It's the U.S. stock market cap reached around $64 trillion at its peak. That was more than 2.2 times GDP. That's the highest on the way up in almost 100 years. And yeah, maybe it doesn't matter anymore, but maybe it will.
Mike, I also want to get your take on this idea of, basically let's say the canaries in the coal mine of crude, signaling that it's going lower. You're expecting it to go lower in combination with copper. We're seeing this, let's say, global slowdown. How do we combine that with this idea of tariffs? What would really putting, large tariffs on the already, let's say, deflating world economy or deflating demand, what would that do to the economy of the world?
So you nailed it with that question. Pre-existing trends, not a good thing when you have something to add fuel to the fire. So the pre-existing trends of crude oil is already heading lower. There's a glut of crude oil. I mean, it's the lessons of that great Canadian Jeff Booth who wrote the book, The Price of Tomorrow, and also the book, The Domino Effect. I can mention a dozen other books of technology is moving so fast. It's great for equities, it's great for companies, it's great for the AI-driven S&P 500 and NASDAQ. It's bad for producing, bad for the price of a commodity that you can replace every day by technology. So crude oil is going down already. So I've been early. Some people say I've been wrong. I've been calling for $40 crude oil for 2 years. And I think so right now about $70. The next $30 in crude oil, I think, is more likely to head towards 40 next year, particularly if we have a little backup in the U.S. stock market and we have supply coming on from the U.S. I think 100 is pretty good resistance. Imagine what it's going to take to get 100, some kind of supply shock, which we don't want, which might mean something nuclear in the Middle East and or Africa. But the key thing about tariffs is I refer to the book by Robert Lighthizer, No Trade is Free, former trade representative for Trump. And he wrote the book well before Trump was even leading in the polls and pointed out that these tariffs are going to happen. It brought back memories of things. I remember talking to clients and debating when running money. This is decades ago. What I said earlier is, everybody wants free trade as long as they run a surplus with the U.S. You just look at the world from say an alien lands in the world. Who do you want to sell your goods? The U.S. is a 10. There's only one country, maybe even close to 3. And that's what, Germany or UK. In the size of GDP that might have a demand pull, there's no such thing as a free trade. And without something to offset this, it just doesn't happen because it's just such an offsetting demand pull force. And then with the, who has the U.S. also provides the base currency and a lot of security for the world. I mean, who protects shipping lanes? My son, my nephew's in the Navy and a nuclear submarine. So the bottom line is tariffs are way overdue. They are going to happen. They're going to be disrupting. They're going to pressure the rest of the world. Most of the major exporters, China, it's about 20% of GDP. For most of Europe, it's closer to 25% of GDP is exports. And I think with U.S. and Canada, it'll be worked out because that's a great trading relationship we all want to keep. And this block of U.S. and Canada is just a wonderful, safe situation. Let's keep us cozied up, but maybe just a little bit of Trump pushback, and maybe in negotiation. But with China, definitely. With Europe, the key thing to point out from that book is things I remember reading about decades ago. Is it's just not fair that France can charge 26% tariffs on French and on U.S. wine, and U.S. basically doesn't charge anything. That's just silly. It's about to change. Sorry, we got to straighten this out. And another thing that's really silly is the U.S. charging 3% tariffs on automotive part imports, and most other countries charging 10% on U.S. It's just silly. That's going to change. It's going to at least get hit, and we're going to test it. It's one of those things we're going to see the test. And the key thing about it, remember, is Trump has a complete mandate. He won. I mean, it might not be a great majority, but he won the election. Obviously, he has a Senate, he has a House, and he has the Supreme Court. I mean, if there's going to be a person coming out swinging, he's not getting younger. He's got 2 years more midterms. He's going to come out swinging for homers right away. If you disagree with that, well, good luck. I mean, it's everything that that General McMaster pointed out in his book, At War with Ourselves, Trump is doing. He said if he got elected, he's going to get nothing, completely focus on loyalty. People are loyal to him and do what he wants. So that's going to happen. It's going to happen hard. And I think it's a sign that we should expect. Here's the bottom line. The U.S. is a major excess, just the U.S. alone has a major surplus of, I mentioned earlier, crude oil, grains. And so if there's retaliation, of course, that's going to bottleneck prices. You already seen that happen in crude. It's happened in soybeans, potentially corn. And it's probably going to spark at least the first 10% correction in the stock market we've had in a long time. And if I was Trump, he knows it's overdue. Get it over with early so he can get through midterms and get that over with. So the bottom line is it's going to be a great trading year. I think it's going to be a very good year for gold. And one thing that's probably not going to be as good for silver too, because silver is more in that bucket with copper. But overall, in terms of commodities, I'll end with this. The Bloomberg Commodity Index right now is hovering the spot index. It's the same price from when it peaked in 2011. That was the bounce after the financial crisis. It made that big pump in 2022 on the back of most of the artificial things. And the lessons that commodities are when they pump, they almost always get cheap. So it's been hovering this very narrow range. And I think it's on the cusp of breaking down, particularly if the U.S. stock market breaks down or has a little bit of a correction. And now we have so much enthusiasm for earnings that even our chief equity strategist, Gina Martin Adams, who's been spot on, most notably the last 2 years, points out the market's just way too priced for too much enthusiasm, too much earnings next year, and it's just too excessive, and that we should see a little bit more of a rational pullback.
Mm-hmm. So you did mention earlier that one of the, let's say, leading indicators for what you think could happen to the U.S. stock market, and I think commodities as well, if I'm not mistaken, is Bitcoin. So why do you think Bitcoin is that leading indicator, or why do you think it has developed that capacity?
Starting with our president has put it in the forefront of how it helped him get elected. His transmigrification, I like to say, a word I remember learning as a kid, and I can't even spell. His shift away from antagonist to zealot is epic. And now it means there's a complete burden on this asset, most notably Bitcoin, to go up, particularly because he's made calls and his son has made calls that it should be going higher. And things like the strategic Bitcoin reserve and things like that. But it's also now we've had significant amount of inflows in ETFs in Bitcoin, and significant 4 years in a row outflows of gold ETFs. So, the analog, the digital, highly volatile speculative digital asset has to go up, or it indicates down for everything. And that's a problem I have now, Tom. I just finished writing my outlooks, my commodity outlook for metals. You can't mention gold without Bitcoin in the same space because it is been to some extent demonetizing gold. The thing I've been saying for years now is you can't hold gold anymore without some Bitcoin in that space. It's somewhat irresponsible, not acknowledging the trend in digitalization. But we're at the point where I think Bitcoin just reached a significant milestone. And then you have to look at yourself as it has to go up now. And if it doesn't, it means most of the dominoes indication all the dominoes are going to tumble. I think it's at that stage because of that shift over into our new president, who's basically judging his performance based somewhat on risk assets, which means the stock market, and what's the riskier one? Bitcoin. Also has a very high correlation to the stock market. Right now, 0.5 on a 100-day basis is the highest on the way up ever. Of course, Bitcoin's only been around really for 10 years, realistically. So to me, the key thing also, I think a key thing to think about for next year is, in a year like this, when we've had U.S. interest yields are still high, the stock market's on a tear, and the most significant competitor for gold, Bitcoin, is just taken off, that gold still outperforms the S&P 500. To me, it's a good sign of continuing strength for gold. And gold's had a decent pullback. It's dropped about 10% from its peak. So I think the key detriment and key point looking for gold next year, a key thing that will accelerate is for gold next year is if Bitcoin backs off a little bit, maybe continues to back off from this threshold at 100,000, significant resistance, and makes all those ETF buyers realize that the high speculative digital asset, and what they've been telling me that it just goes up, might not, will make it tilt back towards gold. And we're seeing that uptick in gold ETFs. We're going to have the first up year in gold ETFs in 5. And the key thing, I think, for all that is Bitcoin going down, the U.S. stock market pulling back a little bit means there'll be a lot more interest in gold.
Mm-hmm. It's interesting that you mentioned this kind of, let's say, flip-flop on Trump's part of being a fan of Bitcoin. Somebody a friend of mine sent me this morning, in fact, a tweet from Trump in 2019 that said, "I am not a fan of Bitcoin and other cryptocurrencies, which are not money and whose value is highly volatile and based on thin air. Unregulated crypto assets can facilitate unlawful behavior, blah, 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 blah." It's so interesting to see that change. And it would also be interesting to really sit down with him to understand what his real thoughts on a lot of these key issues actually are. But Mike, I want to get your thoughts towards, let's say, Tether's demand for US Treasuries as basically contributing to Bitcoin's trend performance as well. Is that something that you have looked at and should be taken seriously?
I am so glad, Tom, you put Tether and Bitcoin in the same sentence, because this is things I wrote about. I was hoping our leaders and regulators would see as I published on the Bloomberg terminal years ago. Like, excuse me, if you're an American, the pushback in this technology would be kind of just stupid. You're not understanding the technology. Number one, the most widely traded crypto for years now is not Bitcoin, it's Tether, the US dollar. And by the way, the base layer for this space has gone to the dollar. And it holds a lot of treasuries. So what's so bad about that, other than your misunderstanding what's happening with technology, which good example of the state of Massachusetts prohibiting institutions in Massachusetts that were government related to buy Apple when it went public in 1980. We just know that's how rapidly advancing technology happens. But the point is I want to get to is that's the bottom line base layer. There's things like Bitcoin, which is digital gold. It has definable diminishing supply, increasing demand and adoption. Over time, price must go up. Price has gone up a lot. Pretty good threshold, 100 grand. The problem with the broad crypto space is I used to say there was Bitcoin, Ethereum, made a lot of them happen, and 10,000 wannabes. Now, on coinmarket.com, there's 2.4 million wannabes. What's the rules of unlimited supply? It ain't good. And then you get things that's just happened recently. Like, what is a Dogecoin? I don't really know. It was basically launched as a joke. Its market cap this week reached $60 billion, which was above BNY Mellon, which has been around for 200 years and has significant profits, I think between 10 and 15 billion a year. So it's signs of, I think it's very 1929-ish. Maybe 1999-ish, maybe 2007-ish. The things the froth and speculation we're seeing in cryptos is just, it's wonderful for a trader. I'm an ex-trader. I'm from the trading pits, and everything I did in futures was leverage. I get it. It's great to buy low, sell high, and just trade. But when you get valuations this high, it's just a sign of speculative excesses, and prudent investors say, thank you, probably sign the book. Time to book profits. And I think that's happening in Bitcoin. I think 100,000 is a pretty good threshold. Big picture, sure, I get it. But the whole space needs some purging. And that might all relate to the U.S. stock market being very expensive versus GDP, very expensive versus earnings, versus commodities, versus gold. Any measure in history, we all know it's nothing new there. And sometimes it just takes a trigger. Oftentimes, the key thing that happens is when risk assets get this high, get this stretched, and they go down, that's your recession. That's your deflationary recession. The key thing I've been pointing out for most of this year now is when you have the U.S. stock market on a tear like this, and crypto's kicking up lately, and running 2 times GDP, it's very silly to expect inflation to really decline when you're creating that much wealth. It's the most ever. $13 trillion added to market cap and stock market this year. It's the most ever. So crypto's just a good example of speculative excesses, and we're in, bull markets don't just roll over. They usually end in pretty extreme enthusiasm, and we're getting that.
Mm-hmm. So we can kind of, let's say, separate Bitcoin's price performance and maybe overheated demand nature from the continued demand from Tether. Is that a fair way to kind of put that, Mike?
I look at Tether as what Kai Sheffield from Master Visa described about it. Was it 4 years ago? He did an interview with Laura Shin and pointed out, hey, it's just a better way to transact. Instant settlement. It's the technology. It's a tokenization of the dollar. It's the technology is overwhelming where you can settle your dollars virtually for free, 24/7. Overnight. You don't have to wait for a bank. You don't have to, it's only less than 5 days a week to be open. The technology is overwhelming. So to me, Tether to me represents the technology that I came from the futures market. What the futures market did to mitigate risk. So I remember being in a trading pitch in Chicago, and being on the phone with the New York traders, and they would get so mad at how the futures would move the trading pit. Now, this was in the 80s. And so this is just how the world's changed with technology. Now you can transact in the dollar globally. I remember learning that. I was in Hong Kong 2018, and some of my colleagues, this was before the riots, told me, Mike, this is the first time in history we've been able, I mean my colleagues over in the mainland and anybody who's got repressive governments and deflating currencies can get access to the buck on their phones. So Tether's revolutionary. It's flawed. There's a bunch of other, but it's crypto dollars. It's the technology that I think is significant. The thing is, what I find is it's the fact that you see most of the people in the world trading different currencies, different cryptocurrencies with Tether rather than their own currencies, which shows you the dominance of the US dollar on a global basis. There's nothing even close. It's like selling a product. If you're an alien, you want to sell a product, you look at every country. Okay, well, there's 110 in the world. It's a US dollar, and everything is maybe a 2 or 3 or below, just for potential open market simplicity, everything. And then on currencies, the same thing. There's one currency in the world that's basically the world's reserve currency, and everything is basically maybe the euro's close. But good luck firing up their 11, 12 aircraft carrier battle groups to support global protection.
Mike, have you looked into let's say the correlation of gold and Bitcoin? And so, could you actually build a strategy around, let's say, rotating out of one at the highs and buying more of the other at the lows, and thinking about it as almost a currency pair rather than gold versus digital gold and the negative connotations around that?
So been very bullish on gold, and I like to say you're not supposed to. I think it's very irresponsible to hold gold anymore without some Bitcoin in space, some in quotes, between 1% and whatever percent you want to do it. But I think that gold Bitcoin ratio, I've been watching that for at least a decade. I first really started watching it when my son first mentioned, he's 31 now, Bitcoin to me, I think it was 2011. And the ratio right now is 38 ounces of gold per 1 Bitcoin. That has put in a pretty significant peak. It's been a great leading indicator. That gold Bitcoin ratio, it usually leads beta, usually leads the stock market. It's been lagging for a while. So I'm glad you mentioned it, Tom. It's actually one chart I put up before I spoke to you because I wanted to go there. So to me, they're in the same space. Bitcoin typically is 3 times the volatility of gold. It used to be, before the futures were launched in 2017, it was closer to 10 times. Obviously, it was a baby. It's still coming down, but volatility is still high. But to me, it's indicating pretty significant divergent weakness. Now, it did make a new high, but it's well below the stock market made a high in April, and Bitcoin gold really dropped, and it's just catching up now. But after this major shift from our president, so I think the risk is it goes down. Some more with the U.S., just to back up the U.S. stock market. I don't know how far, but it's so extreme here. And this threshold in Bitcoin at 100 is so extreme. And the bullishness is so extreme. It's part of being a commodity person. I have the curse of being a contrarian because the lessons of commodities go down because they went up, which is what's happening in crude oil and copper and grains. Stock market's the opposite. It goes up because it went up. I mean, it's just until it doesn't. And at some point it gets there. But that's where I'm kind of concerned about this stretched and lagging Bitcoin gold ratio compared to beta. And that's the key thing that we started out earlier. The fact that gold has been outperforming the stock market, they're significant. Now we know why. The deepest pockets in the planet are buying it. Led by central banks, most notably China. And why? Because there's this Cold War going on, led by one key person, Mr. Z and Mr. Putin, well, two peaceful people. But Mr. Z did the tilt rather than he could pick up the phone someday and say, hey, Don, the new Donald Trump, Mr. President, can we be friends? This guy Putin, he's not working for me. That could be a major shift. I doubt it's going to happen. But I do love that Bitcoin gold ratio. I've been watching this Bitcoin gold index for a while. CoinShares puts it out, and I think it's a good way to be involved in the market. But it's what that index does. CoinShares has a gold Bitcoin ratio. It weights based on volatility, which I think is appropriate. Since Bitcoin has 3 times the volatility of gold, it should be weighted much less in a portfolio than gold.
But just to expand on that just a little bit more, Mike,
sure.
If you thought about it again as a currency pair, and let's say riding Bitcoin up, selling it near, these big resistance tops, and then, rotating that back into gold, is that correlation relatively dependable?
Sure. Well, it depends. I think from a trader standpoint, I have to put in my trading cap. Ex-trader, used to have hair. I think it's an ideal trying to put on, particularly because it's so global macro. I think it's the best leading global macro indicator there is, and I'm sure there's other ones that are, but that's traded 24/7. Gold less so. But yeah, I think it's ideal for that, and I'm sure there's a lot of bots doing it. And I look at it as a great indication. I'm afraid. So gold, Bitcoin right now at 38. That just a little reversion gets it back to 10. That would be a shocker for everybody. But you look on a chart, it looks like it's done in history, and just if we get a little normal 10% correction in the S&P and the S&P 500, that's doable. But we'll see. We'll see how it goes. I mean, it's right now everything's so bullish. Bitcoin, all the Bitcoiners are so bullish. They point out so many bullish things, which is usually when they have to be careful. But I think it's an ideal trading pair. It's one of my favorite leading indicators is gold, Bitcoin. I'm sorry, Bitcoin gold. Sorry.
Right. What do you think the role of ETF demand in both gold and Bitcoin plays, and is that also, a leading indicator here?
Typically, flows like that can be lagging, and I think the excessive flows into Bitcoin ETFs right now could be a sign of over enthusiasm. But let's point out the facts that we have had the biggest ETF launch ever in history. There's been about $35 billion of flows into Bitcoin ETFs this year. Total market cap tracking Bitcoin from ETFs. It was around 135 billion. Now it's probably down to 130 as we speak. Bitcoin's at 98,000. Bitcoin got as high as 108,000. And at the same time, for 4 years in our growth time, we've had outflows in gold ETFs. I mean, your average 30-year doesn't care about the boomer rocks, as they call them. But I think what's happening is we're starting to see a bottoming pattern in those ETF holdings. The metric I look on the Bloomberg terminal, it peaked around 110 million ounces in 2020, and it's bottomed just this year, just below 80 million. Now it's running around 83 million. It's turning back upwards. So I think this year is going to be an up year for gold ETFs, and it's debatable what's going to happen to Bitcoin ETFs, particularly if the price backs up a little. But the thing I sat down to do some analysis to be able to pick and maybe produce an outlook of what the Bitcoin price could be based on ETF flows. And then it struck me, the lessons I've learned in commodities and gold ETFs. Gold ETFs holdings have been stuck about $220 billion for a couple of years. Now, the price has gone up, ETF holdings have gone down, but the total amount is about $220 billion. And I just mentioned Bitcoin ETFs got up to near 135 billion. The thing I've learned from investors and RAs my entire career in commodities is it doesn't have earnings. A lot of people are much more comfortable holding the gold equities. Now, they've underperformed rather than the underlying gold. Now, the launch of ETFs made that easy. That was 20 years ago with GLD. But I think that's the crypto people completely disagree with me, but I think that's what's going to happen with all this investors going into RIAs and clients going into Bitcoin ETFs. Is it going to run against that wall? And a lot of them will say, well, okay, we got MicroStrategy and the Qs now, so I can get quasi-Bitcoin exposure there. There's no earnings in this highly speculative digital asset. I get earnings in my S&P 500 stock market and Qs, and they're going up. So why would I take that extra risk? I mean, getting off of zero makes sense, but I think we're going to bump up into that wall of AUM where most RAs say, yeah, well, where's the earnings? And you don't have that in Bitcoin.
Mm-hmm. So, Mike, you brought up this idea of Bitcoin being a leading indicator for, let's say, a market reversion in the stock market here. If we do see, a normal correction, as you put it, as a percentage, what are you expecting? But as an absolute value, does that look, shocking, like maybe a gigantic correction compared to other, absolute level corrections in the past?
Well, that's, I think, a good, well-phrased question, Tom. The point is that everybody knows how expensive the U.S. stock market. It's not a known. It's just a question of riding the wall, worrying what might spark it to have a normal 10% correction, which used to be normal. Mm-hmm. And the quote I hear from everybody now is, well, the system, they'll just throw so much liquidity at the system. We're not going to have recessions or corrections anymore. I mean, it's the kind of things you heard in 1929 and 1999, and like, okay, heard that before. So that aspect of it and is one of the things that are so known that my thought is here. So I'll go on the records. I think we're going to see a 10% correction in the S&P 500 next year. To say that is very not profound in history, but to say it now because people are so bullish and so long at the highest levels in history, makes me have to say it, because do you realize that's just a silly thing not to believe? And then what happens after that, how markets react. I'm waiting to see what happens. So to me, this is part of what I started calling last year the inordinate burden. I could see all the bearish sentiment setting up in commodities, which is mostly handout with the exception of copper, industrial metals, but mostly commodities. You can see them heading lower because of oversupply on the back of the big price pump. And my focus when I wrote my commodity outlook last year was on the inordinate burden for U.S. stock market to go up. Now that's somewhat switched over to Bitcoin because it's the top number one leading indicator, and our president's has staked a bit of his career on it. And we've already had, a decent run. So I look at just a little bit of simple mean reversion next year. We'll see how that should be just a trade. But the question is, when does it become a trend? Mm-hmm. And that is, we do have increasing unemployment in this country. We do have disinversion of the yield curve. We have way overdue for a bear market. I mean, a real bear market, it doesn't make a new high for 5 years kind of thing. And sometimes they don't make a new high for 10 years. But that's so anathema to what the sentiment is right now, is why you have to say it. And you look for alternatives. That's why I keep saying, well, gold's been a great alternative this year. Bitcoin was a really good alternative, certainly at the beginning of the year. And now it's just getting too expensive, except gold isn't. I don't think, not versus the stock market. It might be expensive versus other things. And then I tilt over to me I'd like to point out the number one thing I've been wrong on, Tom, is Treasury, U.S. Treasury long bonds. I thought they would be appreciating, dropping in yield by this time this year. I've been wrong, particularly because I see the pretty severe global deflationary forces in commodities, most notably in China and Europe, Brazil. And I think that still might be the next big trade, or I'll probably have to hit fill or kill on that next year. And that's all somewhat predicated on just a little bit of backup in U.S. stock market. So I'll end with this. The key thing I've been using as a theme forever is, why buy gold? If you're a U.S. or Western investor, when the stock market's on a tear and you can get 4.5% in a T-bill, that might be changing. Questions what sparks it, but I'm fearful we're going to have something that happened in 1929. We didn't get that recession until the very overextended equity market just went down. It created a bit of a reverse wealth effect, and we've had we're basically at the highest, most significant wealth effect from the stock market in our lifetimes, unless someone who's listening to this is over 100 years old.
Mm-hmm. Well, all the power to them if they're still able to digest this information at that age. So, Mike, earlier we kind of mentioned the keys for commodities for 2025, and you put a $3,000 price target on for gold for next year. So is that, kind of looking at, let's say, the fundamentals not changing for gold despite the outcome of the election?
So I'll admit I'm repeating what I said at the beginning of last year and the year before and the year before. So I have to admit, first thing I have to do is admit where I'm wrong, and I got a lot more wrong I can admit, but I'd rather not admit them all right now. Is, to me, gold is just a matter of time. It gets to that threshold. It's not so much a target, it's just a matter of time. And a key thing let's talk about the key risk is Mr. Z picking up the phone and then the Cold War right now and says, I'm done with Russia. They can go on their own. Forget helping this war. Forget supporting these other antagonists. I'm going to tilt over to Donald Trump and be his best friend. Now at the end of that, and keep the stock market strong and interest rates high, that would be a headwind for gold. So let's look at the opposite. More of the same. And by more of the same, we still haven't had that elusive stock market correction. So me, the next big catalyst to get gold really to take off, I should say, some normalization in the equity market, which used to be normal, meaning, we can't just make record highs for year and year and year and get this expensive with it expected to continue. So the biggest, I think, thing for the gold to really accelerate, to have those ETF flows continue to have a first year inflow in a while, is that U.S. stock market going down, which could be led by Bitcoin, and it will just accelerate a pre-existing trend. That's gold beating the stock market. So to me, I'm still sticking in, and that to me is why I put 4,000 in my headline this year. That's a scenario. Let's just look at a normal potential bear market stock market. How you define that? Maybe drops 20% and stays down for a while. Stuff that used to be normal. That to me initially would be a little pressure factor on gold, like it was in 2008. But that would set the foundation for lower yields and for the world, and just have a little bit of disdain in this rapidly advancing stock market price. Just a little give up. I mean, we always have them, when people just, everybody tells you it's in for the long haul as long as it keeps going up. Just to have a little pushback on that. And that to me accelerates gold to the next key round. I mean, right now it's still $3,000. But if you have a little bit of a bear market in equities that stays down for a while, which means deflation, significant deflation, that gets gold towards 4,000, I think.
Interesting. And what about silver, Mike? You think silver ends up lagging behind that because of the industrial demand component being far more prevalent?
Silver's had a bad year this year. And I say that facetiously because it's up 22%, but gold's up 26%. On a volatility silver to gold ratio basis, silver should be up almost 40%. It should have been up 50% earlier. And now it's dropping back below 30. So I'm really worried about silver. Silver to me is no longer, it's not nowhere near a precious metal. It's an industrial metal. It's been demonetized by gold forever. Gold's getting a little demonetization from Bitcoin, but silver to me is much more in a bucket of copper. I think copper it's an industrial metal related to China, and I think it's more likely to go to $3 in copper, which means silver's got a problem. Silver to me is only going up on the back of gold. You look at most of the other precious metals, platinum, palladium, they're just kind of trying to inch up with gold, and they're not, because are central banks buying silver, platinum, or palladium? No, they're buying gold. Maybe they will, but to me, that's the problem. So for silver to really outperform, typically you need, and also for silver to underperform in a year like this with the stock market doing that well, that's bad. The key thing is China. You look at China's bond yields plunging, 176. China's Hang Seng, yeah, it's bounced this year, but it's way underperforming the S&P 500, and it's not doing anywhere near as well as you expect with the Chinese government actually buying it through ETFs. So the key thing I do like to watch is gold silver. Right now, it's 89 ounces of silver per ounce of gold. That upward trend is intact. I think it's eventually more likely to head higher. And it almost always heads higher when U.S. stock market volatility bottoms, and volatility in the stock market is at a basically 10, 15-year low. If you look like the 50-week or 200-day moving average of the VIX, volatility index, and almost silver gold ratio almost always goes up when U.S. unemployment goes up and the curve disinverts, which is all kind of happening right at the moment. And so I think silver gold ratio is more likely to head towards 100. Right now it's 89, than to trade back down much below 79 or so. So let's say it's at 90. So the next $10, the next 10 I think is more likely to hit to 100 rather than get below 80. Gold, silver. So what stops that? Pretty organic demand pull forces recovering in the global stage, most notably from China. And their increasing dependence on fiscal monetary stimulus shows their tilt. They're in a reverting emerging market that made the mistake of cozying up to the wrong country.
Mm-hmm. Excellent, Mike. Well, I think that's a good place to leave it. Is there anything that you'd like to kind of conclude with to leave our listeners to think about or to consider before we do?
Yes. It's unfortunate that I have to focus so much on Bitcoin, but I have to focus when I think matters. And I think the key thing to think about next year is if we can get through this year without a normal backup in the U.S. stock market, and we can stay basically just be at these levels a year from now, that's a wonderful thing, or just be higher. I mean, the thing I'm worried about is virtually every outlook assumes the stock market's going to just keep going up. Mm-hmm. And when you go up 30% in a year, if you go down 30%, you're still up. But what if we do that and it's not even considered? And that's why I'm worried about deflationary forces. So, but I expect from Donald Trump him to take the band off right away. Maybe the sooner we get through some of this correction, the better. Let's just see how it works out. I'm worried, though. Bottom line, I'll end with this. I'm worried about a bit of a normal reset with the lessons of history point out. It almost always happens that you have to have major money pumps and asset pumps like we have been having, and it's already starting in China. I'm just afraid that's going to trickle down to the U.S.
Mm-hmm. Well, time will tell, and we'll have to keep updated with you to monitor that progress. Of course, Mike McGlone on Twitter at Mike McGlone11. Excellent Twitter follow and excellent interview, Mike. Thank you very much, and I look forward to speaking with you in the new year.
Me too, Tom. Thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.